Hey guys, I'm London and I'm back with another video. This video will cover common investment strategies ranked, and it's a broad amount of strategies that would either hurt or benefit a retail investor, especially with that prolonged period of time, the 20 years, that longer period of time. This is not financial advice, this is my opinion. This will go on a tier list basis from S being the best and F being the worst. So first, I want to get into auto investing. Auto investing is by far one of the best forms of investments, or investing your money, simply because it takes emotion out of it. So the thing with investing is that you really do want your emotions taken out of it, because you're prone to making more rash decisions when you see your portfolio go down, or when you try to, again, time the market, such as down here, which is in C tier, timing the market is bad. With auto investing, you don't really do that. Moving along to dollar cost averaging. Dollar cost averaging is when you just put in money to a stock no matter what. No matter if the stock is up or down, or whatever asset you're buying is up or down. So for example, I would put $5 in Google every day, and as you know, the share price doesn't stay the same. It would either rise or fall, but no matter what, I'm putting in $5 a day to Google. That is a very powerful strategy. It has been proven to work over long periods of times. It can bring your cost basis up, or it can bring it down. The only con with this is that if the stock were to keep rising, your cost basis would rise with that, and it would limit your upside gain, but you would acquire more shares, which could theoretically make up for that loss of gain. Next, Roth IRA. A Roth IRA is one of the most powerful, or the most powerful, investment account anyone of any age can hold. Whether you're 18, whether you're 50, I wouldn't say post 60, because that's when the Roth IRA term really ends. But the earlier you get started investing in a Roth, you have $7,000 to max out, and until you're 50, when you're 50, you get that extra bump to $8,000. It's called the catch-up years. And then you get to withdraw all your money tax-free, all your growth tax-free, after 59 and a half. Now, the money you put in is taxed, but again, would you rather be taxed on your gains, or would you rather be taxed every time you put money in? Now, that's the thing with the Roth IRAs, because it's so powerful. It really does use that compound interest factor to keep your investments rolling and to grow them and to defer taxes. So next, S&P 500 index investing. So the S&P 500 index, I'm sure many of you have heard about it. It is the biggest 500 companies in the United States. It's basically a bet on the United States economy. If the S&P 500 index fails, we do have bigger things to worry about. This is probably the best investment to make. The only downside with this is that it's not huge upside. But again, long-term investing takes time. Now, you could say individual stock picking would beat the S&P 500 index. But again, this is for retail investors. The vast majority of retail investors don't do fundamental analysis or thorough analysis into whatever they're investing into. But the S&P 500 can be held both in a brokerage and in a Roth. Again, I advise to hold it in both if you wish, and then use your stocks to satellite the S&P 500 index. Moving along, a high yield savings account. This essentially acts like a savings account on steroids, but it gives you a higher yield to park your cash into. So say I had to buy something about 6 months out from now. You could put it in a high yield savings account. It's just so versatile because you get a great yield. The only downside with this is that it could be certain rules against how many withdrawals you have from that account, because the bank wants to keep the money in that account safe and sound. But if you're not doing anything with your money, or if you don't even invest your money, put it in a high yield savings account. Now again, not investing is the worst thing you could do, and a high yield savings account isn't an investment, but essentially it can work as something that supercharges your investment. Now lastly in the S tier, Mag 7, the Mag 7 rotation. NVIDIA, Microsoft, Google, Apple, etc. The Mag 7 isn't based off of market cap. It's just based off of the best front runners for the time we're seeing today. Again, the Mag 7 can rotate on a year-over-year basis. But what we have seen with the Mag 7 is that they have outperformed every single stock normally more consistently than most other stocks have outperformed them. Most of the Mag 7s are extremely stable. They're not too over leveraged. I would say they're not too risky bets, especially with individual stock picking. I believe the Mag 7, again, they are extremely included in the S&P 500 index. They hold a significant portion of the S&P 500 index. And the Mag 7 is just a really good investment, especially when you get to rotating through the lowest PE ratio of that Mag 7. But I'm not going to really get into that. That's more of a trading aspect of it. But theoretically, you can build a portfolio out of only Mag 7 stocks. Now, the only downside with the Mag 7 is that it is prone to rotation. Again, you can normally have Mag 7s lagging, such as this year with Amazon lagged. But we've seen that before because at the beginning of the year, Google and Alphabet was lagging at the beginning of the year. And now it has a year-to-date performance of 62%, which is insane. So that's really the only downside risk with the Mag 7 is that one of them could potentially lag behind and drag your portfolio down. But if you have good asset allocation, the others should make up for it. Now moving into the A tier. The A tier are not S tier. Again, the S tier, I believe everything in the S tier here can be combined into the perfect investment portfolio or strategy. But moving into the A tier, you have some things that maybe aren't really known to the average retail investor, things that you could advise against, but things you could make a great claim for. Now, first going into it, individual stock picking. This is something that I do, and I believe individual stock picking could be potentially the best. It can be better than the S&P 500. It can be better than the Mag 7 because you're picking stocks that could run up quicker than these. But again, the downside risk is that most retail investors don't really know what they're investing into. With individual stocks, with something such as SoFi, you wouldn't really know what SoFi is. You wouldn't really know the growth horizon. You really wouldn't know the fundamentals of that company. And you couldn't really gauge whether your return for that company would be great or be bad. But most retail investors don't conduct fundamental analysis. Again, something I mentioned, fundamental analysis, looking into a company's balance sheet and whatnot. So for the average retail investor, I would, again, advise against individual stock picking, even though it provides the most upside. Normally higher risk, high reward. But if you're a more seasoned investor, individual stock picking should be your go-to. But that's all I have to say with that. Now moving over, total fund. Total fund investing is not any sort of index investing. It can be a mutual fund or an ETF. It includes everything. It includes mega caps, small caps, mid caps, anything. More than over 2,000 companies included in a fund, and your money is allocated a certain percentile to each of them. Now, this can help you gather gains of smaller cap and micro cap companies that can have significant run-ups. And then it can also help you capture stability of the biggest companies in that. So like Meta can be a part of a total fund, and something as small as like a $10 valued stock could be a part of a total fund. Now, the only issue with this is that some of them do have high expense ratios, which can drag down on your total returns. And then the small and the micro and the mid caps in them can all add up to have a negative weighting, or if they all do perform bad one year, then it can all have a negative weighting or negative return or hurt your overall returns on that total fund. But either way, it's a great way to invest. I personally don't do total funds. Again, it's a little too diversified for me because again, normally the more diversification, the more you have an offset risk, but you do kind of limit your upside in that matter. Now, moving along to an HSA, which is a health savings account. This essentially works as, again, another tax-deferred account. It's a triple tax advantage account, but it's a health savings account. So really the only time you'd be able to withdraw your money before the age of 65 would be for health expenses. But there's only certain ways you can get into an HSA. You'd have to enroll in a high deductible plan for whatever health insurer you're with. And it's just a lot of other things that can kind of complicate this and defer people away from opening up an HSA. But it's extremely powerful because your money goes tax deferred. Your contributions could be taxed, but your gains are tax deferred. So again, if you combine the both, a Roth IRA and an HSA, you have a lot of money coming out of retirement. You can withdraw all your money after a certain amount, after a certain age. Now again, I'm going to piggyback with the Roth IRA. The Roth IRA, you can hit when you make a certain amount of money with a Roth IRA, you don't get it anymore. I think it's $143,000 when you're single, and $260,000 when you're married. You don't get access to a Roth IRA anymore. Now, I'm not a tax advisor. I'm sure it's ways you can get around it. Same thing with an HSA. I'm not a tax advisor. But I'm sure it's certain ways you could go around that, so you can circumvent that to do both of them. Now, next is a strategy I use because I don't have my bank account linked to my UTMA account because I'm not of age yet. But it's something called lump sum investing. That's when you basically take a fixed amount of money. So say every 2 weeks, I think I invest like $500 every 2 weeks. And you just put it all into the market, regardless of time. You don't dollar cost average it. You don't auto invest it. You make your own decisions based off of the money you have. This can be a little tricky because you get caught up in trying to time the market or momentum or trying to get the best yield for your money. And it can be bad in the sense that you might buy at a really, really high point. I've done that a few times. I've put my money in and I've bought at a higher point, which could bring your cost basis up, which could hurt your overall gains. And if that stock goes down, then you lose out on gains as opposed to dollar cost averaging. Now, either or, it's still a great way to invest because at least you're investing and you're not really trying to time the market with lump sum investing. But again, it is what it is. Now, moving along to REITs and to real estate. Now, I'm going to cover both of these. REIT is a publicly traded investment. You can buy into it on the stock market. It's not a physical real estate, but you own partially a part of a house or office building or commercial spaces. They don't deal in houses, and you're paid out through dividends because they don't really promise growth. They have to pay out 90% of their money through dividends. It's income focused. It's a sort of dividend strategy. A lot of retirees can hold REITs. It's extremely powerful. The only thing with REITs is that they can kind of slightly underperform the market. You can get something called NAV erosion, where the money you put in is essentially devalued because the stock price will go down, but you're given income to kind of try to make up for that devaluation. It can work out. I would rather invest in REITs than hold physical real estate. We'll get into that later. But the only thing about REITs is that it's prone to interest rates, highly prone to interest rates, and the dividend tax situation can be a little complicated. Taxes can be a little complicated surrounding REITs. Now, that's not something I would hold. I wouldn't really hold a REIT in my strategy, especially with my time horizon. Like in REITs would be for more. It would be for older investors. It'd be for something like kind of like a bond. It'd be a safer investment. Now moving along to real estate. Real estate will always be a great investment. The only thing with real estate is you have to know what you do. It's a lot of strategies that could go into holding real estate, such as the buy and hold strategy. Again, you can buy land, you can buy commercial spaces, you can be a landlord, active landlord. You can appoint a portfolio manager to actively manage, and then he charges a percent. You can do a lot with physical real estate. The only thing with that is that you do have to deal with tenants. You do have to repair. You do have to put a good amount of money in. But essentially, real estate could be your only investment strategy because it's great. The real estate market is growing. There has been a crash before, but I believe the real estate market will stay healthy because the need for housing and the need for space for people, or just the need for land in general, it's a big need for them. Now, again, the only downside risk is this is that you're holding a physical asset. So with that, you have to put in the physical work. You have to deal with tenants. You have to deal with costs. And you're just holding something physical. Now, you do get a good amount of cash flow off real estate. Again, once you fully pay off that mortgage using that rent money or whatever whatever you acquire from that, it can become a hefty cash flow generator. Again, it's capital intensive. It's hard work. You have to put in a lot of skin to this. And it's a liquid. It's not easy to sell a house quickly as easy as it would be to sell a REIT on the stock market. It takes a while to sell a house. If you want to get out of this, it takes a while. Now, moving along to Bitcoin. Bitcoin is digital gold. You've heard of it. Everyone has heard of Bitcoin. In any other tier list, to some people, it would be S tier. But that's based off its past performance. Again, it doesn't really have much of an underlying asset. It's just a fixed supply of Bitcoin. There will never really be any more made. It's like somewhere 21 million, I believe. It's a decentralized asset with a cap supply. Again, that cap supply being 21 million. We have seen a great increase, and there's been many millionaires made off of this. But again, this is a strategy for a prolonged period of time. And I simply wouldn't invest in Bitcoin. You could hold a little bit of it. It could be a speculative position. With it not being so speculative as much as a cryptocurrency, that's why I separated the two, because Bitcoin is better than cryptocurrency. The only thing about Bitcoin is that it's prone to a lot of macroeconomics. So like the thing with Trump and the Trump administration, what it's been doing in China. Whenever whales pull out of Bitcoin because it's traded 24/7, you will see that dip, you will see that jump, or likewise when they buy, you'd see that jump. It's just really volatile for the valuation that's at, and it's something I would stay away from. Now, thematic ETFs. So I didn't really just include ETFs. I did something called thematic or sectorial ETFs, such as like an industrial ETF or an AI ETF or tech ETF. This can be good, but you're just riding off of a momentum play. And again, with momentum and with timing the market, you can win if you know what you're doing. But again, this is for retail investors. It's a prolonged strategy. And I just wouldn't really advise against it, but I wouldn't really advise to do a thematic ETF. Again, the fees associated with an ETF, you do have to pay expense ratios and whatnot, the fees. Or it can be some buy-in fees, or it can be some you have to invest a certain amount of money into that ETF. It could be an upside play, but the downside risk is there. Now, something next, sector rotation. Essentially close to an ETF, but you're doing it with stocks. So say this year, since the AI boom has been happening, you pour your money into AI stocks like NVIDIA, Broadcom, Cypher, Ion, quantum computing, IonQ, Qubit, whatever. You could capture the upside gains, but again, this is sort of a momentum play in that you could capture some gains, but you could capture some downside risk. You can invest in the peak of that sector rotation and you can be left bag holding. And you're trying to outperform indexes. You're actively trying to outperform the index. And if you end up not outperforming the index, why would you even try to individual pick or sector rotate in the first place? Now, next, precious metals, gold, silver. You've seen the run up they've had. It's been great. But many people nowadays think that gold is an investment or silver is an investment. And you're not wrong, but normally these are hedges against inflation or against your investments. Because silvers or gold especially normally retains its value. Now, it can be volatile. It can go up. It can go down. Again, I believe gold is going to go down in the near future. I believe the whole precious metals industry will go down. But it can act as a necessary hedge in your investment portfolio, and there has been some proven good strategies. Now, it's tricky because the precious metals industry has had such a run up, so it would deserve to be higher on this list. It's just that the average retail investor could get caught up in that this is a value play when essentially it's not. It's just a hedge against inflation. Now, dividend investing. This is a tricky thing because when you're older, dividend investing can be a great thing. People can retire off dividend investing. SCHD, Coca-Cola, companies that pay out dividend. Again, REITs pay out dividends. The only thing with this is that you can get caught up in the yield, and that you can get caught up in that net asset value erosion. Again, that happens when you invest in a stock that pays a high dividend but doesn't have the cash flow to cover that dividend, but just keeps investors intrigued by increasing that dividend when they don't have the cash flow to cover. So the share price will fall down, and you basically are just receiving money for the amount of money you lost. And the taxes. Dividends, they carry some sort of tax with that. Your tax typically more heavier than your growth assets. And even with that, historically growth has outperformed dividend investing. Normally dividend investing should be reserved for older people. But again, you see a lot of younger people getting trapped in those yields, those monthly payments. I just wouldn't do it. It's limited upside in that fact. It's even more downside in dividend investing. Now, target date funds. For example, 2045 fund, 2065 fund, you get it at work, whatever, they pick it. You essentially don't really have much control over your target date fund. I would just advise against a target date fund. It's great that you're investing your money. It's great you're getting a match. But essentially, I wouldn't really do it because one size doesn't really fit all. And it's a little conservative. Again, you're going to be outperformed. You're definitely going to be outperformed by the S&P 500 within a target date fund. And you might as well just throw your money into an S&P 500 and just set it and forget it. Now, moving along to covered calls. Now, essentially, I'm not big into the option strategies and the covered calls. But essentially, it's when you hold a stock and you gain income off of that stock. When you hold a certain amount of shares of a stock and you just gain income. But the only thing with that is that it limits your upside gains with that. Now, it's great in sideways markets, but covered calls are essentially tricky because it can limit your upside. You can get valuable income off of it, but it just limits your upside gains. And that's not something you would want for a prolonged period of time. You want to capture all the growth in the stocks you invest into, not just gain sideways income because the stock's staying flat or whatever. Now next, C-tier. I'm starting this out with bonds. Now, bonds have a tendency to stay safe. They're great. They're a great investment for older people, especially government bonds, treasury bills, T-bonds, whatever. They're extremely stable, but they provide a low yield. I'm not personally a bond investor. I believe I can just stick my money in an S&P 500 and it can grow 4 times quicker than a bond would. That's just my take on it. I'm not going to spend too much time on bonds, but I wouldn't really do it. I would do it when I'm older, but again, it's numerous better things you can do when you're older, such as REITs or dividend investing that would give you a better yield. Bonds are just mainly safe. Cash position, having money free to invest whenever. There's a significance in carrying cash. The only downside is that you could be missing out, and inflation trickles into that cash value. Again, with inflation, you're essentially losing $1 with inflation. You're losing whatever yield that inflation is prone to. And historically, inflation has beaten down cash. You don't want to hold cash. Again, that's really not investing. The only time you would want to hold cash is when you're trying to time the market, such as Warren Buffett. He believes he holds like $386 billion worth of cash. And then he's going to pour that money in essentially when the market goes down. Now next, I'm going to cover these next three: trading off news, momentum, and timing the market. Trading off news can work, but it's a lot of fear-mongering within news, and you really do have to evaluate your sources with that, because people could try to fear-monger. And normally when you hear something on the news, it's already been done hours or days before. You're just hearing the tail end of it. Now, momentum and timing the market, I would advise against it. You can capture gains. Again, with a more seasonal investor, I would put timing the market probably in A tier, because you can't time the market, but you can get pretty close to, like, if you were to develop a thesis of when you want to buy a stock, and that stock were to drop below and then it were to go up, that would be a swing. That would be a positive swing. It would be a swing trade. Now, you can pair this strategy as a seasoned investor with swing trading. When you time the market for a stock to drop, you buy in at that drop price and then you sell for a profit when the stock goes back up. But that requires a lot of technical analysis, looking at the graphs, looking at the charts, and believing that the stock will return to its previous price. Next, option strategies. I'm not going to spend too much time on option strategies. You're leveraged, you're hedging against your investments, you're hedging against the market, you're trying to beat the market by receiving calls or call money or puts money. It's essentially just a gamble. I wouldn't do option strategies. Again, you see a lot of people losing a lot of money off of calls and puts. Again, calls is when you pick up the phone and that stock price goes up. Puts is when you bet on the stock price to go down. Now, option strategies are okay for professionals, but I don't even know I don't really even understand options. It can be a valuable hedge against the market, but the vast majority of people really wouldn't know what they're doing, and you'd lose more money than you would gain with options. And again, a high loss probability, as noted. Cryptocurrencies. I wouldn't really invest in cryptocurrencies like Ethereum. I get it. People think it's going to be the next Bitcoin, but essentially it's not. You're better off just taking your money and putting in Bitcoin. Again, this is a high risk, high reward play, but for a long period of time, you could allocate a little bit of your money to that, a small amount, a really tiny amount, but I just wouldn't do it. Commodities, oil, wheat, soy, etc. This is really just blatantly based off the price and the supply and demand off that. Again, commodities can crash and they can rise. It's just all in the demand curve of that commodity. Now I'm going to add something. I'm going to add like Pokemon cards and physical commodities, collector's items to that. It can be good, but it's just the value is based off the want of that specific item. When the second people stop wanting Pokemon cards and all the Charizards and stuff, the value is going to drop. Now, lastly, getting into F tier, the worst tier. Saving only. When you only save your money, this is how I think of it. When you invest your money, you don't have access to that money anymore. But when you see all that money into a savings account, you would theoretically think it's there and be more prone to spend it. When you're trying to compound your money, and even with the normal savings account, You're given pennies on a dollar as opposed to just getting a high yield savings account or putting your money into a bond and making more than what you're given in a standard savings account, a 0.002% pennies on the dollar. You don't want that. Again, with a long-term period of time, you want more gains. You want your money to compound. Now, savings could work out if you want to be liquid and if you're buying something, but you just might as well put your money in a high yield savings account or a CD for that. Day trading. Day trading is when you buy and sell an equity on the stock market that same day. You're essentially just playing with the market. You're playing with numbers. You're trying to make a profit. But again, 90% of day traders aren't profitable. Enough said with that. Meme stock and penny stock. Meme stocks are essentially like AMC or GameStop. You've made a lot of millionaires on it, but it's no underlying value below that meme stock. You've seen AMC and you've seen GameStop. They've all crashed now from their previous highs. You can make a lot of money off this, but for the retail investor, it's not even worth it. You might as well just stick your $50 or however much money you're putting into this into something a little better like Bitcoin or something. Now, meme stocks are normally pumped up by other people, artificially pumped, and then normally you get rug pulled when you think everything's going great. You see your portfolio's in the positive, and then that big whale or whoever is heavily leveraged in this meme stock, they just pull out, and then that just leaves it crashing down. Penny stocks. Stocks valued under $5. I would stay away from this. It's no point. Normally, most of these penny stocks have declining fundamentals, and they're like that for a reason. I would just stay away from it. You can make some money in penny stocks, but you really have to know what you're doing. You have to monitor it. Again, it has to be more of like a meme stock thing where people are pumping the price up, because penny stocks really have no reason, such as like Beyond Meat. It had no reason to run up 800% in that one day. It did, but it did, and then it crashed back down to where it was, or even further below. Now, lastly, to wrap up the investment strategies ranked, not investing is the worst thing you could do. When you don't invest, you're not building towards your future. Now, you can invest with something as little as $5. If you just save that coffee, that $5 a day, that's $1,825 a year, 5 times 365. You have access to that. And even if you just make a little small 2%, again, that's more money saved, and that's even more of a yield than you would have had if you would have just held that money. Not investing is the single biggest mistake people make when they're trying to compound their wealth. And it's something I quite really don't understand why people do it. Now, it's self-explanatory. Not investing is the worst thing you can do. It's by far the worst thing you can do because you're just missing out. The stock market is really built for everyone. Anyone can make money in the stock market. Again, as long as you know what you're doing. Enough said with not investing. Just invest in something. You can invest in something that you want. You can invest in anything. Just invest in something. But not penny stocks or meme stocks. Now that wraps up my video today. This is not financial advice. Let me know if I left anything out. Again, this is just my opinion on these. I know Bitcoin could have been a little bit higher, whatever. But that's all I have today.